Join us now on the potential impact that the data could have on the Fed's decision of whether it hikes, skips, or pauses is David Wessel, the director of the Brookings Center on Fiscal and Monetary Policy. It was a lot of cross currents this week, David. Depending on which Fed head is talking at the moment. We had, and you could see it in the futures. Did you watch it? Remember, we thought there was going to be a pause when Jay Powell sort of intimated that, and we went to, what, 10% for a hike? We got all the way up to 70. Mester earlier this week. Andrew, remember Mester we were talking about? And then that very afternoon, two of them said we need to skip. Where do you think they are right now? Now, we should be at 50 on Fed funds. We should be right at 50, right?
It kind of reminds me of the days when I worked with Alan Murray at the Wall Street Journal, and he once wrote a story about the Federal Open Mouth Committee. I think that there are two things going on. One is it's getting to be closer calls. When you start at 0 and inflation is 9%, there's not a lot of argument that rates have to go up. Now we're at the close call department. I think the senior leadership of the Fed was not happy with the Fed funds futures, and I think that Phil Jefferson, the future vice chair's speech, was meant as a signal to the markets that they were wrong to expect a rate hike, and it worked. So I think it's pretty clear they're going to skip at the June meeting. What I'm really interested to see is what they say about what the terminal Fed funds rate is in this cycle. In the March survey of economic projections, they said 5.1% was the median, although several people wanted a higher one. I suspect it'll move up, and I think that's the big thing to watch.
We had, I know you watched, David, and know all of our people. Santelli yesterday was saying that for months he's been saying the terminal rate is in, the high is in. And if you look at the 10-year and just the stubborn inversion that we've seen, the 10-year seems to be screaming that the highs are in. Not to say that we couldn't go to new highs, though, or that if it stays really stubborn and if we get a big jobs number again today, maybe we're not. Maybe the highs aren't in, but it kind of looks like they're telling us that.
Yeah, clearly that's what the markets think. I think a lot does depend on how strong the labor market is and what happens with inflation. So the markets, as I read this morning, are expecting 190,000 jobs. We consistently see the reports coming in above the consensus. One of these days is going to be below the consensus, but another couple of months of really strong job reports and inflation being stubbornly slow to come down, I think the Fed is determined to bring inflation down above everything else. And the end of the debt ceiling mess makes it easier for them to look at the economy rather than worry about the functioning of the markets.
David, it's Kelly. I just wanted to ask you about Christopher Waller, because he was maybe you can explain to us his significance to the Fed, intellectually or as a leading indicator or not. His speech about hike, skip, or pause, he seemed to rule out the pause or the skip, but it was much more hawkish than expected, and I think that confused everybody. So right. I wonder what your reaction is to that and how you kind of interpret what he is saying and the heft it carries.
I think Christopher Waller, the governor, the former St. Louis Fed economist, carries a lot of heft because of his intellectual caliber. He knows a lot about monetary policy, and so I think people look at him as a serious voice on the Fed. And he has been one who has been arguing, along with the chairman, that we might be able to bring down the vacancy rate without pushing up the unemployment rate. But I think he's positioning himself as the hawkish wing, and I don't think Jay Powell is quite where he is now. So he's worth listening to because his analysis is sound. But if you're looking for what direction is the Fed going to go, the people to listen to are Powell, Jefferson, and John Williams.
So we were talking about all kinds of job transitions, and I said David's been all over the place. And Kelly said that she used to work with you.
Yes.
So what I'm getting to is that you've got a lot of wisdom and experience, and you got white hair.
No, you never said anything nice to me before. What did you have for breakfast? Must be those donuts.
You're a Fed whisperer. I'm going somewhere with this. You've been watching.
He's setting you up, David.
No, I'm not. You've been watching it a long time. Leisman says that Leisman says we go back and forth on whether there is such a thing as a lag effect with monetary policy. So is there or is there not? And where is it? Could it be in labor that there's a lag effect? Could it be in consumer spending there's a lag effect? Is there? Should the Fed not wait and look around and see where we are in a couple of months before they do anything else, or not?
Yes. So there is a lag. There's no doubt about that. The problem is nobody's sure how long it is. Given how fast they have raised interest rates and how much, it's hard for me to believe that's all been felt in the economy. So I think one reason to skip, but to leave the door open to further rate hikes, is to see what happens to the labor market, what happens to consumer spending now that it's more expensive to buy a car, what happens to business spending since it's a little more expensive to borrow and there's all this talk of recession, so people are hunkering down. But my guess is that Fed Chair Jay Powell would rather do too much than too little. He idolizes Paul Volcker. He wants to be the stiff-spined Fed chair who will bring inflation down, and he's willing to risk a recession to do that.
God, I sure hope that I hope the moment calls for a man like Volcker. It'd be bad to try to fit the moment into the man.
Absolutely, no. There's a danger they'll do too much. You know,
Right.
the Fed last survey of economic projections said that they expected the unemployment rate to go up by 1 full percentage point. That was their forecast. That's 1.7 million people without jobs. That's the population of Phoenix. They are projecting some pain, and they may be underestimating the amount of pain. It could be that the effects of Fed rate hikes are just about to hit the economy, and they will make a mistake. So I think that's why they're skipping. The reason they don't talk about pause is they want to leave the door open later this year to raise again if inflation remains so stubborn.